There is no doubt that we are barreling toward a recession as we've recently seen GDP data completely tank the stock market this morning, but I made a very strategic decision as of recently to actually sell off my dividend ETF SCHD in favor of the S&P 500's VOO, and that was because of the early earnings that we got to see out of quite a few of the holdings in SCHD, and they are just not growing. In fact, I started to believe that the true recession-proof stocks where the growth is going to continue to be is in these mega upper weighted tech companies that have gone through quite a correctional period, and that this earnings would be the defining factor on where the market goes moving forward. And I want to discuss just that as now we start to get a clear understanding of mega cap tech earnings. And I don't care if you want to call them overvalued. That is what everyone's been spieling across the internet. But trading between a 20 and 30 times PE is an expensive company, but you can justify those values, especially at the current earnings we're seeing. So we're going to break some of this down as I've got over $250,000 as of today sitting in the S&P 500. Between the wife and I, we have our money spread across our favorite tech companies. I have huge positions in Google, Take-Two Interactive, Meta stock. The wife obviously has a huge amount of Meta in these tech companies as well. And here I sit kind of really anxious, excited, a moment that so many of us investors live for are once a quarter, once, 4 times a month, we get to experience how these companies are performing and whether we should continue to hold them in our portfolios. Yet right now, after earnings, Microsoft is up 6% in after hours. This behemoth that is trading at a 30 times multiple. Can it justify those earnings? Well, investors believe so, on the back of these recession fears. I mean, we're taking a look at Meta that is now up 3.3%. Google posted incredible numbers and is trading down, which is why I've done everything I could to buy it, because I don't know how Google trades down. I was just joking that, the only way to actually own a piece of SpaceX is through Google. I think Google and another company bought like 10% of the outstanding shares like back in 2015 or something, and they're getting like huge unrealized capital gains off that. I mean, there's so much resilience in these companies, the balance sheets, the margins, they have everything to survive any kind of market volatility or recession-like event, whereas the traditional companies we talked about that are held in SCHD like Pepsi are actually struggling in this market environment. I don't want to say struggling. It's not like they're failing. They're just not finding any growth and they're contracting in their businesses, right? So these stocks are bringing up the entire market in after hours on a very fascinating day where we actually saw a negative GDP in the United States for the first time in months, which Trump continues to deny, continues to say is because of Biden, but we obviously know it's because of the lack of consumer spending in the United States, especially considering the drop in travel and foreign spending in the United States. I think it's the first GDP drop in 3 years, and negative GDP, you need 2 consecutive quarters to be in an official recession. And historically, stock markets bottom, or the market will bottom, before you even find out you're in an actual recession. But these recessions don't matter as much if companies, specific companies, especially mega tech companies, prove resilience, and they're the whole defining factor to the market goes up or down because they make up the vast weighting in most indices, right? So here we sit. We had some earnings over the last couple days. Starbucks, and even the earnings out of these companies I thought weren't terrible. They weren't like explosive or exciting, but they weren't terrible. But they still, some of them rallied, some of them dropped. Domino's, I'm sure you've kind of looked at some of them, but the ones I was waiting for were obviously Microsoft, Meta. Robinhood even posted some pretty good numbers here in after hours. But I want to focus on the megas, and we'll start with the Canadian side of the border, because I recently talked about Canadian railways here, Pacific Kansas City, which posted, and actually shockingly posted great numbers. Like, I was shocked by this railway and what they came out with, because if we just dive into the broad view revenue here from the railway side, I mean, we're talking about $3.79 billion, up from $3.5 billion. This growth was quite astonishing. And if you kind of break down their cost and everything else, their net income was quite impressive. I mean, their earnings per share came in at like 97 diluted versus 83 this time last year. So I was shocked to see the turnaround in the railways. So congrats to the Canadian holders out there that believed in this company, because they've all been kind of trending to the downside. I mean, this thing was trading at a 17% discount and is actually justifying that it can continue some growth here. So quite impressive. Very intrigued by that. that because we were talking about the high valuations on some of these Canadian, resilient Canadian dividend stocks. Yet in the comparable tech companies that I want to discuss, like Meta, trading at far cheaper multiples, yet as we'll see, actually have far more growth ahead of them. I think these things are like buying opportunities of a lifetime right now and continue to be. I mean, look at the drop this thing had from peak to bottom there. I mean, it tanked about 32%, basically wiping out all the AI future, as similar to we discussed with Google. But look at these numbers: revenue, 16% growth. Can't complain at all. And what's even more impressive is they've been able to squeeze their margins up to 41%, driving a net income of $16.6 billion, up 35%. We are talking about a company that is able to grow its value to shareholders by 35% year over year on a quarterly here. And I mean, at a PE of 22 seems ridiculous to me. When these companies like Google and Meta, this is going to bring down Meta's entire price to earnings multiple if the stock doesn't go up materially. I mean, it's the same thing that happened at Google. Google's trading at a 17 times PE right now. It seems absurd. These companies are growing double-digit paces. Like, how can you argue this? And talk about growth, and I mentioned this, that even if advertising money slowed down, the reason that these continue to be buying opportunities is because in the midst of a tariff war, all this crazy geopolitical stuff and election cycles that are going on, we are glued to our screens in ways that we've never been before. Look at the daily active people. I mean, this is insane. Daily active people was 3.43 billion on average for March 2025, an increase of 6%. You know how crazy this is? Ad impressions across family of apps increased 5%. Average price per ad increased 10%. What? Like, guys, even if ad spend slows down, this is growing at an absurd clip. Like, I know 6% doesn't sound like much, but when you have almost half the world's population using your apps on a daily basis, is kind of insane. I was digging through this, and I'm forever shocked at these companies. I mean, let's look at the assets here. We should look at the assets and liabilities, I guess, as well. Let's scroll down a little bit here. So revenue, all this stuff has been great. Net income is astonishing. If you looked at this, you'd be like, this is a buy every day of the week. Total assets today sit at $280 billion versus total liabilities at $95 billion. So year over year, we haven't seen too much of a change in assets. They increased a little bit, but so did liabilities. So nothing crazy here. But I mean, the company's still sitting on total current assets of about like $90 billion, slightly decreased from last year, but they do have some expenditures, but still resilient balance sheet overall. Let's talk about Microsoft here real quick. I was shocked by this. I really thought Microsoft was starting to slow down or lag a bit at a 30 times multiple. I always found Google Meta more attractive, but you have to admit, this company is starting to prove, again, some quite resilience here with considerable revenue growth at 13%, $70 billion. Operating income was up 16%. Net income was up 18%. Whew, baby, for the size of this company, astonishing numbers. If we dive into it a little bit, they do I always look at Microsoft as kind of like an engine, and these are all the pistons that are running the motor that is this company. I mean, 360. Firstly, cloud computing was up 20%. Cloud is driving the growth in most of these companies right now. It's the biggest growth vector, but almost their entire business is growing at double-digit clips. Look at Azure and cloud services, 33%. Whew, baby. I'm still shocked that Xbox is, at 8%. It's one of the slowest, and Windows OEM and devices is probably the slowest growth vector for them. But I mean, their entire operating, business is growing at an absurd clip. Let's just take a look at the bottom line assets, because what's impressive about Microsoft is that they're sitting on this insane $562 billion in assets, which is up like almost 50. Well, it is up basically $50 billion from this time last year, against liabilities of $240 billion, which actually decreased. So the company is actually improving its bottom line, balance sheet. I don't know. I was blown away by this. I don't even know what to say about it. I'm just broad viewing these earnings, obviously, but I'm highly and thoroughly impressed. And I'm going to do a bit more due diligence and listen to some earnings calls, which I recommend you do as well. But there is a specific reason that I made these strategic decisions as of recently to really start leveraging at my age of 32 more into the S&P and upper weighting some of these tech companies, because for moments like this, I mean, you recognize that on the back of everything going on in the economies, and these companies are still able to grow in a quarter where GDP is shrinking, which is gross domestic product. That's the average consumer in the country spending, my dollars moving to your hands. All of that is slowing. There's a lot of concerns, yet here we sit. Companies that act like it's not even going on. If the economy had GDP going up and things were more nominal and there wasn't so much geopolitical and tensions going on, would we be better off than we are right now with these earnings? I don't know how you sit here and scream that tech companies are overvalued and they're so expensive and they're this and they're that. Tesla, sure, I can see it. Nvidia, most of these mega companies today, we'll see what Apple posts, Amazon posts, but so far, man, I am sitting here just in utter awe. But I'd love to know what you think in that comment section below.